The cost of living in the U.S. is on the rise, but experts say there's no need to go into inflation panic just yet. Data from the Labor Department show consumer prices in July climbed 5.4% from a year earlier. The core inflation rate was a bit lower, 4.3%. That rate excludes food and energy. Bottom line, it cost more this year than last to pay for many of the basic things Americans buy on a regular basis. For more on this, I'm joined now by Ann Sonders. She's a chief investment strategist at the financial services company Charles Schwab. Ann, thanks for joining us. What's driving this increase in prices we're seeing?
So over the last few months where we've seen the significant spike in most measures of inflation, you were specifically talking about the consumer price index, has been tied to the reopening as well as supply-demand imbalances and supply bottlenecks. Actually, used car and truck prices has been the single biggest contributor. And that is not so much driven by demand, but more driven by supply. With the semiconductor shortages, which go into new cars, that's put a constraint on production. So absent being able to buy a new car, you buy a used car. And that's really been the most powerful driver of what we've seen.
Now, we're seeing coronavirus cases rising again in parts of the country with lower vaccination rates. Could that slow the economic recovery and fuel more inflation?
So it really is a function of the effect on the demand side of the economy, which would be lower demand. That would not be inflationary. And then on the supply side of the economy. Unfortunately, what we're hearing in the last week is continued shutdowns in a lot of production facilities, warehousing facilities, shipping facilities in parts of Asia, specifically in China, because of health concerns. So that supply bottleneck, that supply chain problem, which has been a contributor to this inflation spike that we're seeing, is definitely negatively impacted by the Delta variant, but it also has a dampening effect on demand. So the question is whether the supply and demand imbalances offset each other and end up being neutral in terms of the inflation story. I think it's too soon to make a judgment on that.
Now, restaurant prices rose 0.8% in July. That's the largest increase in 40 years, and a big part of that has to do with the labor shortage. So explain that for us.
Sure. Well, labor costs have gone up, so have food input costs. And restaurants, in the face of strong demand, given the lockdown had a disproportionate hit on restaurants, the demand is strong enough that restaurant owners feel that they have the wherewithal, they have the ability without hurting demand to pass those higher costs on. The combination of those higher wage costs, given the labor shortages we're seeing, especially in that industry, and be able to pass on some of those higher food input costs as well. The question is, how long lasting is that? Again, the Delta variant could have a dampening effect on the demand side for restaurants, which may mean that restaurant owners have to be a little bit more careful about how much they try to pass on to the end consumer.
And I know it's difficult to predict what's going to happen over the next few months, but can we get a sense of when inflation might level off?
So there are short-term forces that are largely in the rearview mirror, the so-called base effects, because for the last several months, when expressed in year-over-year terms, a measure like CPI is going up against a year ago when the entire global economy was shut down. That caused a bit of an artificial move into deflation territory. So the math is such that year over year, those base effects are significant. That is largely starting to fade because at this time last year into the August data, we had started to see a bit of an acceleration. And then as time goes on, the bigger the boost you get initially, like we're seeing right now, means down the road, the year-over-year increases are likely to be less because that base effect works in the opposite direction. Some of the supply-demand imbalances, supply chain disruptions, you almost have to go service by service, good by good to get a sense of how much longer those kind of kinks in the system will persist. I think the semiconductor shortage, which has been a big problem, not just in automobiles, but across a spectrum of goods, that is probably a longer term phenomenon. And then the last thing is wage growth, whether what we're seeing in wages is sort of a one-time reset or whether it starts to feed on itself and turns into what was called the wage price spiral, the 70s style inflation. We do not see the conditions as in place right now to generate that type of inflation, but we're not out of the woods yet.
Now, there's been so much uncertainty over the past year and a half about the economy and the job market. How can people adjust?
Well, I think that everyone's going to make their own decisions as human beings. Absent federally mandated, state mandated lockdowns, which we're unlikely to see, that of course doesn't prevent individuals from making decisions based on their own health situation. You're seeing it. You're seeing in metrics that are very short-term in nature, very real-time in nature. Things like TSA traveler throughput, open table seated diners, mobility data, and in particular in the states where the Delta variant is surging most significantly, those are the metrics that have started to roll over. So, of course, we all want to do everything we can to maintain our safety. Those would be the factors that I would look at, because we are not likely to go into a situation like last year. And that's how we're going to try to judge the economy at this point.
Ann Sonders, thanks for joining us.
My pleasure. Thanks.